Let's talk about Wynn Resorts and a number that's making headlines: $10.5 billion in debt. That's the kind of money that builds those iconic gold-tinted towers in Las Vegas and Macau. Lately, the media's been buzzing about Wynn's supposed financial meltdown, linking it to a rival's collapse. The story: Wynn is drowning in debt, and MGM's troubles are dragging it under. But is this really a crisis, or just media hype? The truth is more nuanced: less Hollywood, more Wall Street. Wynn's $10.57 billion debt isn't a secret. It's public info, the result of years of building luxury resorts. The real question: is this debt a ticking time bomb, or just the cost of doing business in the casino world? Tonight, we'll cut through the drama and look at the facts. We'll break down what this debt means for Wynn, and whether the meltdown narrative holds up. Forget the scary headlines. Let's see what's really going on. Wynn's debt has been around for years, funding massive projects. These resorts don't come cheap, and debt is part of the business model. The real issue isn't the debt itself, but whether Wynn can manage it. Is this a financial disaster, or just business as usual for a high-stakes industry? Let's dig in and find out. The $10.5 billion elephant is big, but is it dangerous? Time to get into the numbers. Wynn's $10.5 billion debt is huge, but debt isn't always a red flag in corporate finance. The real concern? Wynn's shareholder equity is negative, about minus $1.2 billion. That's a negative debt-to-equity ratio of nearly 900%. It means Wynn owes far more than its shareholders technically own, making investors nervous. But there's more to the story. Wynn owns 38 acres of prime Las Vegas Strip land, valued at up to $1 billion. That land could be sold to pay down debt and stabilize the company. CEO Craig Billings calls it a land bank, a strategic asset, not a fire sale. Wynn is considering its options, including new projects in the UAE and Thailand. Selling the land could strengthen the balance sheet. This isn't a meltdown, it's a company making tough strategic decisions. The numbers look rough, but there's context and a plan. Now, about that collapse of MGM Resorts. The rumor? MGM imploded, triggering panic and dragging Wynn down. Reality check: MGM is still operating, despite financial challenges and a $32 billion debt load. Yes, MGM's stock has underperformed and it's faced setbacks. But, collapse? Not even close. No bankruptcy, no shutdown. The idea that MGM's troubles caused Wynn's problems is pure speculation. There's no credible evidence linking the two. This is classic rumor-mongering, turning a tough quarter into a market apocalypse. Both companies face headwinds, but they're not dominoes falling in a line. Lumping their issues together is lazy journalism. Wynn's struggles are its own, rooted in debt, market reliance, and strategy. Blaming a rival's collapse is a distraction from the real story. Don't buy the hype, look for the facts. The MGM narrative is fiction, not finance. Words matter, especially in finance. Calling Wynn's situation a meltdown is pure exaggeration. A meltdown means total disaster. Wynn is under pressure, but it's still generating billions in revenue. The company is managing assets, considering land sales, and planning future dividends. These are not signs of collapse. Sensational language like meltdown creates panic, not understanding. It can even hurt the company by spooking investors and employees. The real story? Wynn is highly leveraged and facing tough challenges. It needs to deleverage and navigate a tricky global environment, but it has assets, a strategy, and a future. This is a corporate struggle, not an apocalypse. Let's call it what it is: high risk, not meltdown. So, what's really hurting Wynn's stock? Look east, to Macau. The real threat isn't MGM, but the US-China trade war. In April 2025, casino stocks in Hong Kong, including Wynn Macau, plunged as trade tensions spiked. The US even labeled Macau a foreign adversary, raising risks for American companies. Macau is Wynn's most important market, expected to generate half its profits by decade's end. When US-China relations sour, Wynn's future in Macau gets shaky. Regulatory crackdowns, license risks, and money movement all hang in the balance. This is the real story. Geopolitical risk, not corporate collapse. The $10.5 billion debt is serious, but the US-China standoff is the bigger threat. Wynn can manage its balance sheet, but it can't control global politics. That's what should keep executives up at night. Forget the rumors, focus on the real risks. So, where does this leave us? Wynn Resorts is heavily in debt and under pressure, but not in meltdown. The MGM collapse is fiction and the real risk comes from US-China tensions, not rival drama. Sensational headlines distort reality, trading accuracy for clicks. The real world is complex. Wynn's challenges are serious but not apocalyptic. Understanding the difference between hype and fact is crucial. Don't panic over ghost stories. Prepare for real storms. Wynn's debt is a problem, but it's not the end. Critical thinking beats clickbait every time. In finance, facts matter more than fear.